can't really even start the show without talking about what everybody is talking about, and that's Nvidia. Its earnings came out this week, 177% and guiding higher, Brian.
Yeah, it is pretty incredible as far as the strength of the earnings growth that they have shown. Going into it, a lot of people were really nervous. You know, if you look at the price action of Nvidia prior to the release, the stock was down. I think it was about 4 to 6% over the previous few days. Maybe people were thinking, expectations are way too high. But then they just blew those expectations out of the water.
They said, hold my beer, look at these numbers. And of course, and listen to this, Brian, they're talking about higher earnings because of a continued chip shortage.
That's right. Yeah, which is really fascinating because oftentimes in the semiconductor industry, you go through these periods where there's almost a glut of chips, that they over manufacture them. But they are in really a unique position because of the speed of their GPUs, those graphic processor units that they use to power artificial intelligence. And it's going to take a while for other semiconductor companies to really start competing with them. There were some rumors about companies like Intel, TSMC, that they're going to probably be trying to break into that space, but over what time frame? You know, right. I think that's one of the big things is they've really carved out this, what you could call a niche, but it's no longer a niche. This is very mainstream as far as the demand for what they're producing.
And this really comes from, Brian, this widespread experimentation of businesses using AI to become more efficient. So this really isn't going away. But listen to these numbers. The Magnificent Seven, the 7 stocks that we talk about right now, are approximately 30% of market capitalization of the entire S&P 500. That is bigger than the real estate, utilities, communications, materials, energy, consumer discretion, all added together as a sector. So there's certainly an overweight in those 7 companies, but we're going to have to continue to watch that. So let's go back to where Danny started with something old, something new, something borrowed, something blue.
When it comes to something old, the thing that really caught my eye this past week was the Nikkei 225. What were you doing in 1989? Do you remember back then?
I was in the business. I was probably having a beer at the corner bar, though.
Yeah. Well, also, wasn't there a Taylor Swift album called 1989?
It was. I'm not a Swiftie, Brian. I really can't speak. If you're saying it, it's true.
That's right. Yeah. Well, I had to Google it. I have to admit that. But, maybe they were playing some Taylor Swift music from her album of that name because the Nikkei 225, it had hit a peak back in 1989, and it was on a downward slide, rather dramatic one, and then it had just been floundering. But it has recently recaptured that previous
35
peak.
years later.
Yeah, only 35 years, right? Now, in fairness, that's on a price basis. So sometimes with these indices, you have to remember they're not including the dividends. Not that Japanese stocks are really known for kicking off very high dividends, but if you were to actually do a total return, so consider the dividends that it kicks off and then reinvesting those, it actually reclaimed the peak many, many years ago. But it was pretty notable to see this something old, the Nikkei 225, getting back to 1989.
And you talk about that, Brian, and the fact that is there an opportunity to invest, as we talk about the valuation of the S&P 500, to look across both ponds
yes.
to see where there's an opportunity. And so we are watching that because of the fact that it's starting to get some good momentum. But of course, something old continues to be the Fed Reserve and their minutes.
It is, yeah. The minutes were a little dated, because it is looking at what they said at the previous meeting. And we had already had plenty of Fed speakers out there. But it was interesting to dig into that and find out that some of the members of the Federal Reserve are a little concerned about keeping rates where they are for too long, but the majority are still concerned about cutting too soon. So there is this growing divide. It's not like it's a 50-50 split, but there are Fed officials that are really worried that, well, if they don't start cutting rates as inflation continues to hopefully trend lower, that they do run the risk of keeping this soft landing, no landing scenario, whatever you want to call it, that we're going through right now, into something a little bit more dangerous, especially given some of the challenges that smaller banks are experiencing with commercial real estate.
And I think we're going to have to look at that because the Fed meetings are coming up, and they are likely not going to cut at this meeting, but they are certainly going to have to look at it as we go into June and the rest of the year as they get closer to their target.
That is correct. At the next meeting, which is in the middle of March, they are going to be talking about their balance sheet. They've been shrinking the size of their balance sheet. They might want to try to taper that, what's called quantitative tightening, so slow down the shrinking of it. They don't know what they don't know. right? And they do know that. And the problem is, in 2019, they shrank their balance sheet a little bit too much, and it caused some financial problems, especially in the overnight market for money with big banks and the such. And so they're very aware that they need to tread carefully here. And so mid-March, they're going to be having that conversation, probably make some announcement at the May meeting about slowing down the pace of the shrinking of the balance sheet. But then that could tee up maybe June for an actual rate cut. A lot will depend upon the data that comes out between now and then, though.
So let's go to something new, something more important. Go away from talking about me, something old, to talking about something like you, something new.
Yeah, so I would say that the market has been hitting new highs, and a lot of times clients get really worried about, is this the time to sell? We look at the fundamentals, valuations, trading opportunities, and so can't really give a definitive answer one way or the other. It always depends on the context and what you own, knowing what you own, why you own it, and was it at a good price, and is it still at a good price? Remember, it used to be new highs were old hat. Oftentimes, when you look at the data, the market is hitting a new high because things are actually pretty good, and they are likely to continue that way. When we look at things, we know that service sector spending is beginning to slow a little bit, but nothing dramatic. Manufacturing activity is actually beginning to show maybe a few signs of life. The most recent Purchasing Manager Index from S&P Global, they have one that they just released this past week. It actually hit a 17-month high. So it finally got to above break even, meaning that the manufacturing sector maybe has stopped contracting.
When you look at that, folks, the number that we look at is 50. Is it above it or below it? And that's really the break even that Brian talks about. And then lastly, the Eurozone, as we alluded to, may be turning a corner.
It might be. And again, it is maybe a slow turn. That's one of the things from, I think it was in the 1980s that this term Eurosclerosis became kind of popular. The idea that they just didn't seem to be able to get out of their own way in terms of policies that they were implementing, the tax environment, regulatory environment, and all that. But they have been in a recession, 2 quarters in a row of a decline in GDP. These purchasing manager indices that came out are showing a little bit signs of life, not necessarily in Germany, but in more of these what we call peripheral countries, so like Spain, Italy, those other ones that, remember back in 2011 and 12 were the epicenter of some of the angst with the debt problem over in Europe. But now those are showing some signs of life. The United Kingdom is showing some signs of life, but it's early days. I don't think that they're going to make this massive like V-shaped recovery. It's probably going to be more like this Nike swoosh shape.
So moving along, we're going to get to something borrowed. And of course, we all know what debt can do. But, we're recycling some headlines from a year ago. But Nvidia, again, as we alluded to start the show, really came to the rescue.
Yeah, a year ago, it was Nvidia that came to the rescue of the markets. We were experiencing a bit of turbulence early in 2023, and suddenly Nvidia came out with some blowout earnings. There's the launch of artificial intelligence with OpenAI. So once again, Nvidia to the rescue, and with this AI craze. But again, we can also recycle some of the headlines from, say, March of last year. Remember that whole little banking crisis thing that we had with Silicon Valley Bank? Then it was because interest rates had moved up. The value of these banks' holdings of assets, especially treasury securities, had fallen, and that created some problems for those banks. Now the worry is more about commercial real estate. So now that we do know some of these loans are going to reset, need to be refinanced, is that going to start posing a problem? And the Federal Reserve, in their minutes, they actually flagged that as a worry, and they were rather blunt about it. They said the worst is yet to come.
That's concerning. Of course, we always watch those treasury auctions to see if there's enough demand, but they have been a little weak. And let's try to wrap everything up with something blue.
This one I had to stretch a little bit for, admittedly, but one of the headlines that I saw, the airline JetBlue, they were in the Dow Jones Industrial Average. They were just replaced by Uber Technologies. So the ride sharing app, they replaced JetBlue in the Dow. And the Dow Jones, remember, is really created by the people at S&P Dow Jones. It's a committee, and they want to pick about 30 stocks that represent the U.S. economy, and they decided it was time to kick out one of these airlines and replace it with ride sharing. Another big one was kicking out Walgreens and replacing it with Amazon. So they really want this to better reflect the U.S. economy. I think that it's a key thing to remember. Some of these indices that you see, they are very different, whether it's the Dow Jones, the S&P 500, or the NASDAQ. But sometimes they are built by a committee. And so if you're tracking an index, you're basically doing active management, but by a committee where, they're not necessarily aware or paying attention to fundamentals or anything like that of the companies.